We get calls from people who just have no idea what's going on in their retirement plan, and they know they have to do something, they know they need a change, but they don't know what to do or where to go, and that's why they're calling us.
I think the main draw is the concern to run out of money, and I think they're looking for some type of answer. You're not taking double-digit losses, you don't need double-digit gains. Is an extra 5% really worth risking your whole retirement on? When you remove the emotions, it's an objective situation. It's not opinionated. Here's the money that you have. Here's what's at risk. Here's your liabilities. Here's the gap. What do we do?
All right. Hey, welcome back, everybody, to the Greenlight Retirement Show. Tim, Corinne, Ron, how are you guys doing?
Doing good. How are you?
Doing great.
Doing good.
Awesome,
doing
guys.
Doing good down here in Miami.
I know. Our heat wave
Nice
is
and sunny.
over up here in Virginia. Are you guys still staying, pretty decent down there as summer's starting to wind down?
Yeah, August is the hottest month of summer here. So we're into the 90s pretty much full time for this month. But still, that's probably less than it is in New York City right now. So I'm okay with that.
There you go. I like the warmer temperatures too, even though it has been 100 plus here in Virginia for several weeks. But equally as hot is we have some economic data, numbers, gossip, people losing jobs, people trying to get fire other people. Like, Ron, help us make sense of what's going on out there right now. I mean, we've had some crazy revisions to some economic numbers. Like, what's going on? What's the state of the union, so to speak? Like, is America okay?
Right. So there's a lot of question on that front. We have been counting on the fact that the economy is okay because the job market has been solid. It's been stable. We've been doing good. We've been averaging about 150,000 jobs a month, over the last 3 months.
Okay.
And a lot has been said about that, hey, see, the tariff effect is not hurting us and we're okay. And then last week we got a jobs report that came out that made massive downward revisions to those numbers and actually revised May and June down by 258,000 jobs. So almost a 250,000 jobs that we thought were there, actually didn't exist.
Mm-hmm. Interesting.
And the expectation was for another report well in excess of 100,000 jobs, and it came in at 73,000 jobs for July. The vast majority of that was simply in the healthcare sector. So if you remove the healthcare sector, then all of a sudden we're looking at 22,000, 23,000 jobs created in the month of July. So that's a big change from 150,000 average per month. Mm-hmm. And there was a lot of question about that. Obviously, the administration did not like those numbers.
Yeah, didn't they let somebody go?
Within the same day.
Yeah,
within the same day, Trump had fired the chief of the Bureau of Labor Statistics, and that caused a lot of concern amongst economists everywhere because everybody relies on the data from the BLS to do their forecasts, and we just count on it for so much. So there's a lot of concern over what's going to happen there. So there's a lot of political pressure to put out numbers that are favorable to the administration, and then there's a lot of concern about how much can we count on these numbers? Are they real? Can we rely on them or not?
Yeah, I mean, termination aside, that's the first thought that runs through my head is 258,000 jobs revised seems like a massive revision. And how
it's huge.
And
huge.
For
that's
people,
one heck of a correction, like an oversight. Like you just didn't accidentally leave something out.
Yeah, it's not like it's beyond forgetting to carry the one.
Yeah, that's a full calculation error, right? That's
right.
Is there any data to say why it was being revised? What errors were found or what was over? It sounds like an entire sector or something was left out.
Well, most of these things are rely on surveys, and there's a lot of concern that maybe companies are either not responding to the surveys, or they're over responding, or maybe they're overly optimistic, or maybe the survey takers are, not following protocols, or there's a lot of question that comes in there. And that's dangerous because now we wonder, can we rely on this data?
Well,
Is this something that we can use?
because we need that data, because in another hand, right, we have to make, we as in the Fed, or with monetary policy, they have to make decisions, right? If unemployment does start to increase, that's a recessionary sign, right? And the Fed's supposed to get involved when we don't have full employment. But that, at the other end of the spectrum, we have an administration that wants lower interest rates and things like that.
It's good for the economy, for growth. Yeah.
Correct. So how do we rely on this? Where does the market go? I mean,
I always take the stance that you have to look at the economics and go with the facts. But the problem in this conversation is that the facts don't seem right. Something major happened. That was a miscalculation to give you this data that was off by so much. And and we're saying it's the surveyors, it's like, did ChatGPT make a mistake? Like when people are out there taking surveys, that's a major, major mistake. Almost as if the algorithm, the process itself was wrong.
Yeah.
Something big happened. Are they going to dig into that to confirm? And maybe that's why Trump's upset. Like, hey, you guys made a crazy error. What happened?
Well, you have to remember that there's always revisions.
Mm-hmm.
There's always revisions going on. Sometimes they're higher, sometimes they're lower, but they're always happening because it takes time for any survey results to really get fully processed. So this just happens to be a confluence of events, I think, of different things that all came together to cause this big miss that we see. The question is, what's going to happen moving forward?
Yeah, it gets into,
obviously they're going to put somebody new in. Yeah, and how is that going to affect things?
It gets into investor expectations, right? Sorry to jump in there, but isn't that investor expectations? Like, because right now there's an expectation on the futures, if you look at where rate cuts should be, that there should be, 2 to 3 rate cuts are being forecasted in there. But if we're having, potential unemployment issues and things like that, can we still justify cutting rates?
Well, that's the argument, right?
Cutting rates would be great if we're losing jobs. That's exactly where the Fed would go, because they have a mandate for full employment.
Sure.
Right. So if the economy's slowing down and jobs are being lost, they want to grease the wheels, as it were, by cutting rates and stimulating the economy. And that's all well and good. The problem is, within the last 2 weeks, we also had a report on inflation where we see it ticking up again. And some of the pass-through effects of all the tariff policy seem to finally be making their way into the data. So if it's true that we are getting an increase in the inflationary pressures and that may be sustained, then the Fed has a real problem. The question is, will they? Well, yeah, I guess that the question is, what is going to be their priority?
Yeah.
Is it going to be, because they have 2 mandates, a dual mandate: price stability, which is fighting inflation, and full employment, which is stimulating the economy if jobs are being lost. So which do they choose? Do they fight inflation, or do they help with employment?
Interesting.
And the history of the Fed has been, in the last 30 years, they would prefer to fight inflation before worrying about the jobs.
Well, inflation does have a direct effect on employment. So I think that that's probably the better way to go if you have
let's talk through
choice.
Every action has an equal and opposite reaction right here. So, if we we are the Fed here and we just choose to fight inflation, doesn't that mean instead of a potential of 3 rate cuts, and easily, less to 0 rate cuts this year, and depending on how bad inflation ramps up from here, potential rate hikes from here? Like, this is the literal
potential.
This is the literal opposite of what investor expectations are out there right now.
Right. Absolutely.
Growth.
And here's and this is the struggle that we're all having right now. There are forecasts out there that range from no rate cuts this year all the way to we're going to cut by 0.5% in September.
So what are your thoughts then?
The middle of the road. Well, the middle of the road is 3 rate cuts this year and another 2 next year. By July of next year, we'll be 1.25% lower than we are now.
Okay.
I think that's reasonable based on what we're seeing.
Do you think any of the possible inflation numbers could be because of that action that we talked about with inventory and suppliers buying their inventory in Q1, and now it's just being reflected like later?
Well, that has So I'm sure that has something to do with it to some measurable amount, but the real concern is more along the lines of, so that would have been a one-off event. They're not really worried about one-off events, like a one-time price adjustment like that is not a real big problem, because then you know where it came from and then it's done, and then we move on. What they're worried about is a sustained series of increases in inflation. And that's the concern with the tariffs. And, we're finally seeing some real impacts of the tariffs. Just bringing it back to our own little space here. One of the folks in our company with Fitzwilliams, his wife works for a Swiss jewelry and watchmaker. And they're facing right now 39% tariffs. That's pretty crushing.
Yeah.
And they're having to reevaluate as a company, what do we do? How can we continue to operate in the United States?
Yeah.
So these are real things. They're having real effects.
There was an article recently about the cost of Rolexes is going to go up because of the tariffs.
Oh, yeah.
In the new market. Yeah, I think that's the thing. I think also a lot of luxury goods are. Chanel is increasing their prices. I'm not sure. I read something similar as well. Luxury goods are increasing because most luxury goods are outside of the U.S.
Yeah, I was going to say they're predominantly manufactured outside the U.S.
Right, but that's on new.
Right.
Yeah.
Well, also when the price of the new stuff goes up, the price of the second bought goods does too.
Yeah, secondhand market.
Yeah.
The secondary markets will rise. Definitely.
Yeah, they will.
And really, I don't think that's the object of Trump's ire when it comes to Switzerland. It is really pharmaceuticals. I think that's his thing. And he's even gone out there and talked about the potential for pharmaceutical tariffs to rise as high as 250% moving forward. So clearly that's his target, but other things are getting caught up in the mix. So it is having real effects. The question is, will it be a sustained series of inflationary pressure, or will it be one-off effects? And at this point, we still don't know.
All righty. Well, we'll leave it there for now. We're going to take a quick break, and we'll be right back. All right. Welcome back, everybody. We have too much fun during a break. Sorry y'all missed that, but we're going to try to talk about some of the things we were just talking about here. But, one of the things that led us to this part was, it's kind of weird to be saying some of these next things that we're going to talk about. The market is really darn close to all-time highs. It's made a few of them already this year. And we're actually pretty concerned. Not just because the market feels toppy or anything like that, because we're not advocating or positioning that way, but because of the risks that are out there. So we thought it'd be a good opportunity to table for conversation the risks that you take inside investment management accounts and overall your general balance sheet and how you're set up as a client. Ron, you made a comment earlier about personal balance sheet. Do you want to just kind of cue us up and get us started for this conversation on managing your risks and diversification?
Sure. So what I was thinking about there was if the U.S. economy is slowing, and if we are on the verge of at least a growth recession, if not an all-out recession, then all the companies around have been talking about the potential recession. Corporations have been for quite some time, and they've been shoring up their balance sheets and making sure that they're ready for when this hits. So it just makes sense that if we are heading into this sort of environment, this negative environment, that individuals need to look at their personal balance sheets and make sure that they're in a good position, because you don't want to be overdone on debt. You don't want to be overextended on those things. You want to make sure that, it's in a good place. And so, I would say now is a really good time before that kind of environment hits for us for everyone to look at your personal balance sheet and see, where am I? What am I doing? What changes do I need to make?
Yeah. So if things get more expensive, tactics like having a little bit more cash on hand. If you've got, a building project, you're going to do those retirement renovations later this year. Those are some things that you might want to be considering. You want to start extending your time horizon in some ways of the money you have readily available for cash, because the crazy thing about the stock market is it's always, everybody knows, everybody knows the adage that you sell high and you buy low, right? But how do you know when you've achieved a top? you'll never know that this was the top of the market until you go past it. Right. And so that's what Ron's alluding to right here, Tim. And those are things that you and the team talk about, in financial planning meetings where we can give, fiduciary advice. But what are some things that you think about, Tim, when you start thinking about just, hey, the run has been pretty good. We're concerned, is this a take the chips off the table model right now? Or is this just a, know where the exits are type of a situation? What do you think when you hear some of these things?
I don't think it's a flight to safety. I don't think it's take the chips off the table as long as everything is being taken care of that you need in your personal life. So if your income is coming in and everything's good and you can afford to take risk, then fine. I don't see a problem with that. The real question is your mindset right? Like you said, you don't know if you're at the top. Mm-hmm. So if you become, what we were talking about during the break, if you become complacent to news always saying something's happening or that there's, higher unemployment, or like we talked about, there was less jobs. Oh yeah, it's just another report. No big deal. I don't see it in my portfolio. And you take that stance and you continue investing around that stance that my portfolio, my personal setup, whether it's in the market or out of the market, is bulletproof. Then when something does happen, you're not prepared. So I really like your point there, Brian, about you don't know until it's too late. Mm-hmm. So then one of the ideas is to make sure that you are diversifying for your own personal benefit so you're prepared to pivot any way you need to and maybe not be so bullish or headstrong in a narrow viewpoint. Yeah. Maybe it's time to widen out a little bit. It's okay to still be bullish, but maybe be a little bit more wider so that you can move a little bit easier. Mm-hmm. Or if something does happen, you're not taking as much loss with that event. And what we're worried about here, I don't want to take your thunder, you mentioned it during the break, but what we're worried about is when everyone's okay with everything and little factors start to build up, all of a sudden the pot boils over and you have a black swan event or an exogenous event you can't control, and then everything crashes. Yes. And you want to have the mindset that that could happen anytime, but not the mindset that I need to be completely safe right now or in this real conservative mindset if that's not your normal mindset. But let's open our minds up to be a little bit more fluid thinking about our risk diversification. That's how I look at it, Brian.
And Corinne, I want to bring you into this because you deal a lot with the emotional side of planning here. And can you speak to some of the listeners here relative to some of your experience in talking with clients about, maybe not having a plan or maybe having apprehensions about making a plan and maybe about how they feel, afterwards from doing an exercise like this and just making sure, I made a comment earlier, making sure you know where the exits are. Mm-hmm. Tim's point's loud and clear. You don't necessarily need to run for the hills, but you should, do a 360 and make sure you know where the exits are and have a plan there. Like
a lot of our clients are older. And one of the things that I noticed is that people that grew up in the Depression era, their parents were taking any nickels and dimes that they had and they were hiding it under the mattress. They were burying it in the backyard. They were saving it because they no longer trusted the banks.
Sure.
And I feel like because they saw their parents doing that, there's a lot of people that are just taking their money and saving it because they're afraid to put it out in the market and risk ending up like their parents did. Mm-hmm. And I think that when they come in and they sit down with us and we show them, because we go like from top to bottom. I mean, I hated it when we did it with our own bank account and you saw what I was spending at Target. But we really do, like, if people don't know where their money is spending, we kind of show them, like, where are you overspending? Where are you not overspending? And once you know what you have and what you're spending and what you are saving, it allows you a little bit more security to feel like you can put 20% in this or 30%. You don't have to throw all of it on black at the casino, but you don't want to keep all of it in the mattress. Right. And sitting down with you guys and being able to find that happy medium where they can feel safe and get some growth. Because if you just try to live off of the money that you saved, it might run out before you're gone. So being able to sit down with people and see how many years do you need to go on and show them that you can do things in a safe way, in a smart way, I think that that's helped a lot of our clients just kind of get over the fear that their parents had instilled in them.
I think a good budget is the key there. A lot of people just don't budget. A lot of people just see their check come in, know what it is, know what they have in savings, know what they have in their investment accounts, but they're not actually budgeting to feel comfortable. You bring it up all the time, Brian. Most retirees are never going to spend their accounts down.
No.
And so they could afford maybe a greater budget, afford to live life a little more, while all at the same time being aware that there could be potential risks that you weren't expecting inside of your
you know,
life.
also speaking on that, the budget concept, a lot of families, because they've been married 20 years and they've had like one person paying the bills and one person doing the grocery shopping and one person doing, you know, different tasks, it's easy to just start feeling like, well, I know what we need to do because we've been doing it already. And the real issue is like when a medication cost increases or when you can't get the car you wanted for the price that you were expecting and suddenly your car bill goes up, or, you know, different things jump into your budget that you're not expecting and you're not used to. And because you've been budgeting on a whim, like just I know what I'm doing, it kind of makes it harder when these issues come up, like medical care or, you know, a new expense that you weren't expecting. So I think that sitting down and having your budget looked at and planning so you have the emergency funds and all that makes a big difference too.
Yeah, I'll say that this right here is some of the most important part of the conversation of your financial planning meeting, whether it's with me, whether it's with our team of professionals, or even your financial planner that's out there. If your financial planner doesn't know your income and expenses fairly accurately, how do we really know what goals we're trying to accomplish here? I'm going to save my $1 million just in case I need it for this. And you ask them like, hey, what's an expense that's greater than say $20,000 or $30,000 that you need in a week and you can't finance it? And other than a ransom or something like that, nobody can give you a good answer. And it's like, well, why are you hanging on to $1 million that way? Why are you hanging on to $500,000 that way? Generate an income plan for yourself. Work with a financial team so you can know where your money's at. You can know where your budget is. You know where your emergency funds are. You know where your investment dollars are for growth, where your dollars are for income. You know what to expect when it comes in. And when you know these things, it's going to give you the confidence to be able to approach these situations that are scary. We have the portfolio manager saying, hey, we're at market all-time highs, but I got a lot of reason to be concerned.
Right.
Not our clients, right? Because they have a plan. They know where to go. They know what to do. They know they can give us a call. Take care. We'll see you next time.